Thanks for joining, everyone. We'll get started in just a few minutes. Please let me know if you can hear me and see my screen all right. That'd be quite helpful. For those who just joined, we'll be starting in just a few minutes. Could someone please confirm that they can hear me and see the screen? We'll get started in one more minute. Thanks for waiting. As always, after the presentation, feel free to message me with any follow-up questions, or if you ever want to learn about different topics, you can also reach out and we can try to set different presentations up or send different materials your way. Perfect. So yeah, let's get started here. Well, thanks everyone for joining. Tonight we'll be covering small account trading tips, or basically tips when you're trading with a small account. So this is under Eagle Investors Infinity Stream series. So today I'm Samuel Keolian, Chief Risk Officer at Eagle Investors. Probably see me in the chats and whatnot. Specialize in basically a variety of strategies, volatility trading, some earning strategies, as well as trade futures when it comes to more of the macro trading side of things, especially in this kind of macro environment where there's a lot more interesting trade opportunities than there was, say, 10 years ago, 5 years ago. So today we'll be covering, what's considered a small account in the first place, trading small and management guidelines, spreads and mixed strategies, and how you can best utilize those, particularly with a smaller account, and why that's important. And then how to treat a small account in general, as a lot of it has to do with maybe your perception of it and going about that in an optimal way. And then we'll have a Q&A section at the end. But again, as always, feel free to message me after the fact or whenever you wish, and I'm happy to help out or respond in any way I can. I'm also an investment advisor representative for Eagle Investors, so I'm able to give personalized investment advice under Eagle Investors, which again is a registered investment advisory firm. So we're able to provide that holistic type of advice around your specifics of portfolios, certain positions, or just in general personal finances. So first, what's considered a small account? Typically, small trading accounts are in the $5,000 to $10,000 range. On the lower end, $2,000 to $5,000. There's also constraints up to like 25,000, 50,000 plus, really, when it comes down to being able to fully diversify a portfolio with no limitations on or very few limitations from the retail perspective on what you can and cannot trade. We generally don't recommend trading options with under $2,000, as risk management and diversification is extremely restricted. And what do I mean by that? We'll get into some of the ideas of trading small and with a specific amount of at risk of your portfolio each trade. And the bottom line is, if you're trying to not risk or place trades with more than 5% of your account, when you have a $2,000 account, that severely restricts what you can and cannot trade. As then 5% of 2,000 is $100 there. So if you trade options, $100 is quite restricting. Now, if you do have an account less than $2,000, what I'd recommend is an alternative would be trading stocks with it and getting the hang of trading through stocks first, basically. Most brokerages allow for fractional shares, so that shouldn't be a constriction, as well as paper trading options until you're comfortable and able to either fully fund an account or grow that account up to the size where you're not only comfortable with trading options, but you're not starting off behind by setting yourself up to be restricted in terms of risk management. The alternative there is individuals take like $2,000 or $1,000 and kind of understand that they need $5,000, $10,000 to try to balance that. And instead of not trading with that $1,000 in the option market, they just swing for the fences and try to double your money week over week, and just have to do that a few weeks to then trade conservatively. And that's kind of by definition gambling right there, and you might as well just take it to Vegas and put it all on black or red or whatnot, although I wouldn't recommend that either. So the biggest thing with trading a small account is sizing, right? So there's always going to be that temptation to oversize. And the reason for that is, again, because you're going to be extremely restrained with what you can and cannot trade. Now, it's hard enough to find a worthwhile position that looks favorable, that you like, you think has a positive expected value and whatnot. And now we're adding a restraint based on size that is kind of out of your control in a sense. And you might really like it. Like, let's say you really like, well, all the prime examples have already split. Let's see. Let's say you really like, want to say, there's actually not that many expensive stocks anymore. Well, let's say you really like Apple, for example, or okay, let's say like you want to trade the Nasdaq. That's a $285 underlying right there, or even the SPY, right? $400 underlying, and these contracts that you're looking at could be hundreds and hundreds of dollars, and that doesn't really fit within your risk management and trading guidelines, right? It falls over 5% maximum risk in any individual position, but you really like that trade. Now, most would just say, okay, for this one trade, I'm going to make an exception. I'll put my risk of the portfolio at 15%. That can be my max drawdown there. And I just really like it, so hopefully it will play out. And that's kind of the very, very much the wrong way of looking at things for two reasons. The first thing is you have to be extremely disciplined with the way you trade and quite methodical, or else you're going to keep putting emotions in the mix, and essentially you're not going to trade mechanically to the point where you don't know what strategies work best for you, as well as when emotions get into the mix, typically your trades become a lot worse and you're kind of doubling down on risk when you shouldn't be. I also want to point out, taking more risk, it's not just about being able to sleep well at night, knowing that any one position can't go down a certain amount and be a meaningful drawdown on the portfolio. But let's look at it in terms of just kind of how the math breaks out and why you want to limit portfolio drawdown in general. So you might think if a stock goes down 10% one day and then goes up 10% the next day, it's at the same price and you're flat, right? 0% gain. That would actually be incorrect. Let's say you have a $100 stock, it goes down 10%, now it's a $90 stock. If the next day it goes up 10%, it's a $99 stock. So net, you're down 1%. You lose $1. The reason that that's important to think about and conceptualize is it's the same for your portfolio. If your portfolio goes down 10% one day and up 10% the next day, your portfolio is still down. Now, it's only down by 1%, so it's not the end of the world, right? But let's say your positions are much larger. You're taking more risk, and maybe you think you're comfortable with that risk, but let's just see how that's going to make it a lot harder for you. Instead of your portfolio going down 10%, where you have to gain 11% to break even, if your portfolio goes down 50%, now you have to gain 100% to break even. And you can imagine how, from 10% to 11%, not a huge difference, and how difficult that might be to kind of reestablish that break even point. But to go down 50% and now to have to double your money, it's going to be kind of exponentially more challenging to reach break even and then exceed that, as hopefully break even is not the goal for your trading account. So the biggest thing is really focusing on not losing money before you can focus on good trades and making money on these trades. And a big part of that is not allowing your drawdown to be that large. So trade small and trade often. That's the kind of what we preach. Tasty Trade has the same kind of method in that sense. And again, it's better to risk like 2 or 3% of your portfolio than 5%. 5% should be that upper limit. And again, it can be extremely restricting with small accounts. So we'll get into some ways to work around that. But at the end of the day, you shouldn't be adjusting your risk metrics and guidelines and rules based on your account size. You should just be looking at it as another filter for what you should be able to trade and what you shouldn't. And it might be challenging if everything lines up and it looks perfect, but you kind of have to have that discipline to proceed and walk away from a trade. Or again, we'll figure out how we can adjust most trades to fit your portfolio size. But if you can't, you just have to walk away from that trade. Other thing I didn't touch on was reaching true probability. And basically what that means is So if you flip a coin, right, 50-50 chance of heads or tails, zero expectancy, meaning, in aggregate, if you made $1 on heads and you lost $1 on tails, you'd be flat, break even over, 10,000 coin flips. But it's foreseeable that if you made $1 on heads and lost $1 on tails, you could be down like $3 pretty easily, and that would actually happen, 1 out of every 8 times you'd get or I don't know. There's like a 1 out of 8 chance that you get 3 tails in a row. So basically, it's not that uncommon that you could be down $3 at a certain point, even though the expectancy is zero of that, let's say, trade or that coin flip. Now, in the same light, let's say we made $2 on every coin flip and we lost $1 on every coin flip. Still 50-50 chance at heads or tails. I'm sorry, you made $2 on heads, lost $1 on tails. 50-50 chance though. Now that's an extremely good trade, right? We would take that every day. The issue is you can still get 3 tails in a row from a probability perspective pretty easily. And if that wipes out your account, or if that draws down your account 50%, now you went from having an amazing trade strategy, an amazing trade, great positive expected value on that trade, and you ruined it with the way you sized your position, and also how probabilities or chance or luck played into that particular sequence of events. So my point there is, what are the odds of you actually losing money though if your expected value is that great because you had a $2 payoff on a hedge and a $1 loss on a tails? If you did 10,000 flips or 10,000 trades, it'd be a 0% chance that you'd lose any money on that sequence of 10,000. So obviously it's challenging, and that is one focus to find those trades that have a positive expected value in those strategies. But it's just as important, if not more important, to understand, even with a winning strategy and winning trade idea, you can really ruin it and blow your portfolio by not understanding sizing and risk management. So we want to reach that true probability, and reaching that true probability will not only minimize that portfolio drawdown, but it will maximize any expected value that we have with the trading methodology that we choose and the specific trades that we decide to enter. So moving on into guidelines for management on smaller positions. So in general, it's going to be very similar to how you view a larger account. When it comes to general good trading practices, those continue to apply. There are a few differences that I'd like to note, and there are reasons for them. So sometimes doubling down or averaging down on trades, let's say you have a losing trade, your thesis still holds, and you're willing to take the risk. There's still a lot of time on it, and there's no reason that it should be down. It's just cheaper to get in now. Could be a time to average down and take that risk with much higher payoff now that you brought the average down. Same thing with doubling down. That could either be on the upside or downside. If a trade is going with you, it looks like the trend is extremely strong, going your way, and it has a lot more to squeeze out basically. You could kind of double down and be able to realize more of that with a more significant amount of your portfolio. Now, why do I say we shouldn't do that in small trading accounts? The reason is you're almost definitely going to be over your risk limits in these events and in these cases. It doesn't matter if it's a position that you really like, or a position that's doing poorly, or a position that is doing really well for you. If you were to increase that allocation on that individual position, you're likely putting yourself at a position or a place where your portfolio could see substantial drawdown, and you're just taking on too much risk there. So next is to obey initial stops and scale out of winners. So this is generally a good practice for all portfolios. Again, you want to set up a stop on any trade you enter basically, and ideally you set that stop up, or that stop loss up, before you enter the trade. when your objective to the different levels, you have a thesis for your trade, and you set that up basically, and then you have to follow it. Once you're in the trade, you get caught up in emotions, you get caught up in not wanting to realize a loser or the euphoria of like a winner, and your judgment can get clouded. So again, we want to make it as mechanical as possible, and you want to obey the initial stop. Now, one thing to note about that, and this is for all trading accounts, is the way that it goes from idea generation to, let's say, like trade order execution. You should start with the idea, have a thesis, basically. Could be technical, fundamental, whatever it is, whatever strategy you're implementing. Doesn't matter, but the same sequence of events should take place where you have that thesis, then you construct your view on with that thesis, and then basically you want to structure the best trade to minimize risk and capture that thesis if it were to play out as you think it will. And then once you have that structure, maybe it's a certain spread, or maybe it's just buying the stock as opposed to going into options or something of that nature, then you want to have certain targets that you set up before you execute, and then also a place that you would stop out of the position. And oftentimes people place their stops basically at a pain threshold, as opposed to where their thesis is disproven. And this is a big common beginner's error, I'd say. Let's say you're willing to lose $500 on a trade, or let's say that's 5% of your account. That's not where your stop loss should just be. It shouldn't be just $500 down. It should be where your thesis is disproven. And what I mean by that is, let's say, you have a specific thesis, and that thesis would be disproven if the underlying goes down to a certain point that would put your trade minus $1,000. That doesn't mean that you should take that extra risk. And it also doesn't mean that you should have a tighter stop loss. It means you have to adjust your sizing, basically. So you adjust the sizing based on where your stop loss is, and you place your stop loss based on where your trade thesis is. Again, if you have any questions on that, happy to answer that after or over direct message. So the next is to scale out of winners. And the reason for this one is it's good to do that. Some people do it, some people don't on normal size trading accounts, let's say. But in smaller accounts, it's particularly important, I'd say, as you want to realize some of those profits as they're coming, essentially, so that you don't end up being up, let's say, $500 or $1,000, and then it turning, and then you're back to flat on that single position, because you're naturally going to trade less, I'd say, and have less of those opportunities to have those winners. So scaling out of it will increase basically artificially increase the win rate while maintaining the same average winnings or earnings, let's say. So another question is, okay, how do I take profit on positions with one contract? I think that's one thing you'll find if you're trading options or even stocks or futures or whatnot in a small trading account. You're often just going to buy single leg or single lots, single contracts and all that. And that's great, right? The issue is, how do I scale out? How do I manage? How do I adjust if I only have one contract? And the best way to do that is you have to have a margin account to be able to trade spreads. So we'll get into spreads and how we can also utilize those. But let's say we have a call option and on Apple, and it's in the money by $10. We're up 300%. We're up, $2,000. We want to realize some of that, even though our thesis still holds. It still has time. It's still looking very good. What we can do is we can sell a call, that's at the money and lock in a few 100% gain, while also still allowing Apple to run a little bit and us to capture some more upside. So we'll look at that kind of example as well. Then we also want to learn to adjust our ideas to fit our position size. or portfolio size. And what I mean by that is, let's say we're extraordinarily bearish on Tesla, let's say. Now, that could warrant just a long put option. Even with volatility high where it is, likely bid up in these volatile market conditions, it could be that the best structure to express that trade idea would be just the single leg long put option on Tesla. Now, let's say though that would put your risk at 10% or 15% of your portfolio. You have to adjust that. You should adjust that structure to fit within your portfolio size and your risk guidelines that you set up before. And the way to do that, it doesn't mean that you have to do a conservative, or relatively conservative at the money debit put spread with a 1-to-1 risk reward. What it means though is you could do the same kind of far out of the money put, but you just could do a put spread instead of that put. And you can still have, I was looking at some of these today, attractive 8-to-1, 10-to-1 payoffs. Risk $1 could make $10 on some of these. Obviously, the underlying still has to move your way a substantial amount, and it's a low probability of profit trade. But you see how making that one adjustment, you can still realize a spectacular amount of upside, but it is different than the structure you might implement with no portfolio size constraints. So now going into spreads that we just touched on the last slide. So with long calls and puts, they're easiest to conceptualize. Oftentimes that's what we start trading, but spreads offer a range of advantages, particularly in small accounts. Now, one nice thing about spreads too is you can really adjust the structure of the trade based exactly on where you think the underlying is going to go, as opposed to calls and puts. You basically just have to be extremely bullish or extremely bearish for it to make sense to go long a call or long a put. For spreads, however, you can just be mildly bearish and trade a bear put spread, at the money bear put spread, or mildly bullish and trade a at the money bull call spread. Or you could be neutral to bearish and trade a bear call spread, or you could be neutral to bullish and trade a bull put spread. It's also worth noting bear put spread is synonymous with short put spread or credit put spread, and bull put spread is synonymous with long put spread or debit put spread. And these are also called vertical spreads. So I know there's a lot of terms, a lot of them overlap, can be confusing. If you have any questions, feel free to message me about that. There's some good resources on tastytrade if you're learning those terms and how they overlap. Investopedia is also great for any finance term, even in options when it comes to more of the basic kind of terms without having to open up some type of 1,000-page textbook. So now, why are spreads particularly advantageous for small accounts? There's a few reasons for that. One, there's a smaller buy-in, an inherent risk in a spread, basically. So let's say we're looking at a bull call spread. Instead of buying a call, let's say $100 call, we're buying that same $100 call, let's say it costs $5, but then we're selling a further out of the money call on top of that. Let's say we sell the $110 call, but we bought the $100 call for $5. We sell the $110 call for $2. Now our net debit, the amount we're paying for this, is $3 instead of $5. So, that's $2 cheaper. Again, that's $200 cheaper, basically. And again, what's the upside though? Yeah, we're capping our upside. If the underlying goes over 110, we don't make any more money. But again, if it was $2 and $3, we can still make $7 on a $3 investment. That's what is that, 233% gain? And we can really adjust those based on whatever our view actually is. let's say we're, neutral to bullish, we could look at a put or a bull put spread and we sell the put option, and then we buy a put option that's further out of the money. Basically, if the underlying stays where it is, we profit, or if it goes up, we profit the same amount. It's also worth noting that when it comes to the credit put spread and the credit call spread, so again, that's the bull put spread is the credit put spread, and the credit call spread is the bear call spread. Because these are credit positions, they have the opposite kind of impact that our debit positions would have when it comes to our option Greeks. We have some great videos on Eagle Academy and within Eagle Infinity about option Greeks and how to manage portfolio with the Greeks, so I won't go into it too far, but basically, you want to be collecting theta, that theta decay, and too often individuals find themselves extremely long volatility without actually wanting to be long volatility. And that is a result of, being long calls and long puts, which is our long volatility positions. They're long vega, so to speak. And you don't necessarily want that, as if the market volatility contracts, you might find yourself losing money even if the underlyings aren't moving anywhere. So you're losing on theta decay, volatility is contracting, and you're losing there as well. So you want to balance out your portfolio, not just from the delta perspective, not just being all long or short, but also looking at volatility and theta and gamma and the likes. So yeah, that covered the mix of credit and debit. Greater underlying opportunities just has to do with, if there's certain expensive stocks that you couldn't be able to trade the single legs with because of your account size, you can now trade them with a spread. I mean, the best examples were like Tesla and Amazon before they split, but now they're a lot cheaper. So SPY is one of the most expensive underlyings I can think of now. And then lastly, they're more flexible when managing options. That's what I touched on a few slides ago. Let's look at another example here. With that same bull call spread, let's say we buy the $100 call and we sell the $110 call. Now, if the stock shoots up 20% and we're up 150% out of the possible 230% upside, maybe we want to realize some of that gain now and limit our risk. We don't want to be able to lose $3 anymore. Again, that $5 minus $2. So what we could do is we could either roll the call up or we could roll the sold call down. Basically, we want to tighten the spread and limit that risk. So we could sell this $100 call and buy the $105 call. So let's say we're able to sell the $100 call for $7 and we buy the $105 call for $2 or $2.50. So that means we just collected we just collected $4.50. I don't know what my numbers were exactly, but we collected $4.50, and our initial purchase of the $100 call and the $110 sold call was a net $3. So now we're up $1.50, and we can't lose. That's locked in basically. We're locked in $1.50, and we can still make another $1 basically. So that shows how we can roll up that call. We could also roll down the sold call and do the same type of thing. Some of the benefits of multi-leg positions and mixed strategies. So again, mixing credit and debit spreads can limit the theta and vega risk. I mentioned this on the last slide, but what's this actually mean? When you're long a bunch of calls and puts, you're not just extremely bullish or bearish on those specific underlyings, but you look at what actually determines an option's price, and a large part of that is extrinsic value. And what's extrinsic value or time value made up of? Basically, the amount of time left in the option and how volatile, or the implied volatility of that particular underlying. Now, the reason for that is you can imagine if you have a $100 stock and you want to buy an option with $100 strike price a month out, if the option was to be a year out instead of a month out, there's a good chance it's going to be worth a lot more money. Same holds true for if the implied volatility is 10% and versus if it's 100%. So think like, let's say you look at General Electric versus Tesla. Which one's more volatile? Probably Tesla. So people are going to spend more money or pay more money on the Tesla option, even if it's the same underlying price and the same time till expiration. So because they pay that, you end up being long volatility, and you're paying theta. It's the theta decay. So that means if nothing moves, basically, you lose money on the theta, and it means if volatility contracts, you lose money in the extrinsic value of the options that you hold. Now, volatility is naturally mean reverting. When it's bid up, it's more likely to contract and go down. It's kind of easier to predict those cycles than if an individual stock's going to go up or down, as stocks aren't naturally mean reverting. So looking at the broader environment, and maybe you have a view on volatility, you think it's going to expand or contract. Now you're able to actually incorporate and express that view into your portfolio. Now, what can you do with spreads that we looked at, those vertical spreads that you can't do with long calls and long puts as well? And this is nice for small accounts as well, because it's not restricted toward big accounts. Even though we're talking about maybe higher level concepts and whatnot of option Greeks and managing a portfolio and being extremely diversified, not just from different underlyings, but looking at the various ways of risk in your portfolio, is we can short iron condors, or we can go long iron condors, and we can basically take a view on strictly volatility. So what's an iron condor? Basically, it's just putting together a bull call spread and a bear call, or a bull put spread and a bear call spread together for a short iron condor. Again, you can just imagine that this line disappears and we have that exact payoff. Or the bear put spread and the bull call spread, and that's a long iron condor where we profit from huge moves in the underlying. If you've heard of strangles and straddles, it's the same thing. It's just you sell the options on the outside, or you buy the options on the outside as well, to turn it into a defined risk strategy as opposed to an undefined risk strategy. The last thing that I wanted to spend some time on is the idea that you want to treat your small account as if it were big. And what I mean by that is, even if the amount you're trading with is insignificant, you must trade it as seriously as you would with a larger account. Now, when it comes to trading more broadly speaking, again, it's already challenging enough to find a strategy that works for you, to find individual trades within that strategy, to structure it properly, to, again, set that trade thesis with specific price target, stop loss, how it fits within your broader portfolio in terms of delta risk, theta risk, volatility considerations, and then managing all of that on top of it. So you might be inclined to either not want to put in that amount of work when it might be an insignificant amount of money for you, or it is a significant amount of money for you, but the upside isn't going to be as enormous as, if you're trading a $100,000 account or $1 million account. If you're trading a $4,000 account, you shouldn't be looking to, double that every week or something like that until it gets to 100,000. That's basically setting yourself up to have a $0,000 account to then trade. So the upside isn't as high because the starting amount isn't as high. So we want to look at it from like a percentage standpoint as well. And if you were to treat it as if it wasn't important, basically, again, with all that difficulty that I mentioned and how much goes into it in the first place, that mindset would basically be setting yourself up for failure from the start. Next is, this will lower your likelihood of increased and unnecessary risk-taking, negligence, and greed. So again, risk-taking, again, this is what I've seen probably hundreds of times the last few years when individuals have small accounts. They're so caught up on wanting it to be a $20,000 account or wanting it to be a $50,000 account that everything they've learned or everything they know is right kind of goes out of the window if they haven't really thought about it and put into practice a lot of these teachings and thoughts when it comes to risk management, trade setup, diversification, sticking with your rules and being consistent and all of that. And it basically turns into a gambling account where they want to trade conservatively. They know how to trade conservatively, but they want to reach a certain point before they turn on that switch. And there's two things wrong with that. The first is now you're just gambling with an excuse to try to have a bigger account to then trade properly. And the second issue is once you have that mindset, you're not going to turn that switch. And let's say you get lucky and you do triple your account in a week or a month. Now you're going to want to do that again. And that's like a vicious cycle that inevitably ends up with a bust account. Unless you have some phenomenal strategy that triples your account every month, in which case, if you can do that like a few dozen times, probably be richer than Elon Musk. So good luck there. I wish you I hope it happens. That would be quite exciting. Don't try to do it though. I wouldn't try to do it though. The next, besides risk taking, is negligence, and that might be something as simple as, okay, I have a $4,000 account. I know I should be, keeping track of kind of the trades I'm putting in and managing my positions and searching for new opportunities and doing everything I'm supposed to. But does it really matter? I'm not like super concerned about that. Maybe it's not a huge percentage of your total assets or your salary or what you're trading in, maybe a separate account. And that kind of negligence will also kind of hurt you and likely result in account failure. And then lastly, touched on this a little bit, greed. Yeah, I don't know what it is about smaller accounts, but oftentimes it's not those $100,000 accounts or 200, 300, 400, 500,000, $1 million accounts that have the individual account managers greedy about wanting to double it or trade it extremely aggressively to smaller accounts. And I think that's likely because, if you are trading a $1 million account, options account in particular, if you did have that greed kind of mindset or excess risk taking and negligence, you wouldn't be in that position in the first place. So it might just be a filter, and that's why you don't see it in the larger accounts. But that's something to definitely watch for. And if you see yourself kind of getting there, take a step back, maybe stop trading for a few days, maybe write down what's going on, look to maybe the Eagle server, certain advisors and whatnot that you think might be able to help you or work it through with you, and then kind of set you back right on the right path. And then lastly, have a plan to enter and manage trades, and have a specific risk management approach. So again, this holds true for all accounts. It doesn't matter if it's a $2,000 account, $10,000 account, million, or $1 billion account. Maybe those $1 billion accounts are going to have some more sophisticated analytical risk management internal systems in place. They have millions of dollars of research and PhDs building, but the general concept and what they're trying to do, it's all the same. It's being extremely methodical, not letting any emotion get into the mix of things, limiting risk. Like risk is the limiting your downside, and the risk is the biggest part of any individual retail trader or any institutional, let's say, hedge fund or whatnot, and their success. I know if you've heard of Paul Tudor Jones, but he's one of the greatest futures traders out there, the greatest macro traders. Paul Tudor Jones, PTJ, and he became famous, I think, right after the 1987 flash crash. Or was that the 1987 crash where the market went down like 22% on a Monday, because he was matching up with what was happening in 1929 basically, and was entered that day extremely short the market and profited, I think, a few $100 million or whatnot, but basically then grew his fortune to many tens of billions of dollars as a result. But what he likes to say is basically too many traders and investors focus on just trying to make money, pie in the sky investing or trading, he says. But if they spent 90% of their time focusing on not losing money and then only 10% of their time on trying to make money, they'd be a lot more successful and better off. And that's something that's particularly interesting, as too often that risk management side and emphasis on not losing money comes as an afterthought, or maybe it's not an afterthought, but again, you're focusing 10% of your time on it, while 90% of your time's on the maybe more exciting side of pie in the sky investing, and this is going to go here, and I think this is going to happen, or this earnings is going to blow it out of the water, and all of that. We love talking about that, discussing it, and you do need good ideas and good trades to profit. But again, if you take away one thing from this presentation, it's that the risk management side is, let's say, 9 times more important. And even if you do have an amazing trading strategy, if you don't have that risk management side, it doesn't matter. If you have that positive expectancy, you have the best trade selection out there, it doesn't matter. You're still going to not be able to run a successful portfolio, and it's going to end up in a portfolio bust. Obviously, we don't want that, but it's also a nice thing because it shows that, why do many investors and traders lose? Again, it's not because necessarily it's the hardest thing to come up with trade ideas and theses, but a lot of them just get filtered out from that risk management side of things. And that's something that you can plan, that you can get ahead of, that you kind of know what's right or wrong, and you just have to make sure to follow it, be extremely disciplined with that. And then, as Paul Tudor Jones says, you'll be far better off and a great trader. So to summarize, trade small and trade often within the limitations of your portfolio size. Again, I recommend no more than 5% of your account in any single position. Much better if it's like 2 or 3%. Again, that just has to do with limiting not just the risk of any individual position, but limiting your portfolio drawdown. And again, it's important to limit that portfolio drawdown, as 10% drawdown is fair to recover from, but a 50% portfolio drawdown is a lot harder. It's also important to note that, let's say you have 20 tech positions that are different underlyings, but they're all call options out of the money on tech stocks. If those are highly correlated underlyings, which they likely are, that's not 20 separate positions and you're not diversified. So don't think you are, and you might as well just have your whole account in one position, which again, I wouldn't recommend. So understand the correlations between your different positions. We've done presentations on beta weighted deltas. Tastyworks is great on that, but basically looking at your overall delta exposure and your exposure to the broader market to equate, what's a Microsoft put option? How much does that offset an Amazon call? Or what about, Occidental Petroleum? If we're in that, is it really that correlated to Verizon? You got to look at some of those correlations and judge, as well as not just being in one expiration, one direction, on one sector. As you can imagine, that was obviously an extreme example. Next is to manage your positions conservatively, aiming to minimize drawdowns. Again, that had to do with not doubling down, increasing exposure and risk. Again, we need to minimize that drawdown. Focus on not losing money before the focus on making money. And again, that's good advice for retailers just starting in the market, and the billionaire hedge fund managers spend a lot more time on not losing money than making it. Third is trade vertical spreads over single leg options. Again, especially in this environment where volatility is bid up, you likely don't want that long vega exposure, but you can cheapen all your calls and all your puts with a vertical spread. If you're extremely convicted, just go further out of the money, and you can still have attractive risk rewards of 3-to-1, 4-to-1, 5-to-1. But if you're less convicted, it's even better, because if you were to just buy a long call or you were to buy a put option, it's kind of unsuitable. The underlying has to move a tremendous amount for you to even break even, let alone realize a sizable return. But if you were to get an at the money debit call spread or debit put spread, it's a coin flip. It's 50-50. If you do have that thesis and it goes your way, then you profit. If not, then you lose. But it's not going to be, a 5%, 10%, 15% probability of profit there. It can be a lot higher, 50%. Or on the credit side, go up to 70, 80, 90%. And then lastly, treat your account as seriously as if it were substantial. Again, that we just summarized this slide, so I won't spend too much time on this point, but you can't treat it as if it's only, $4,000 or it's only $5,000, $10,000. You have to treat it like, we have a session called Treat Your Trading Like It's a Business. You got to treat it like it's a business, basically. You treat it like it's a sizable amount of capital. And when it comes to your returns, look at it from the percentage standpoint, as you can always scale into it. Did you go up 20% in a month? That would be phenomenal, right? Or as opposed to looking at your account and looking that you only went up $400 with all the work that you put in there. It's more important to get the fundamentals down, the practice, risk management protocols, trading methodology, strategy, implementation, and all of that. And then when you're comfortable, or if you have the means, then you can actually take your small account and slowly grow it to a big account, or you can increase the funds of it to then trade your large account with more confidence and ability. So that's all I have on small account tips. We'll go to a Q&A section here. Feel free to directly message me or message me in the Infinity chat. If not, I'll go back to the slide, but I'll show this is the end of the small account tips. Thanks for joining, everyone. Really appreciate your time. This will be uploaded onto our website for our Infinity members to review and to watch within the curriculum as well. And here's our fun disclaimer.